another update for Tapestry, stock ticker symbol TPR, and this is after the earnings call. So before the earnings call, when it was at $17, I said probably there would be an uptick in the price, or that's certainly what people were expecting. I wasn't certain, but nevertheless, that's what I expected too. And instead, I was obviously quite wrong. I apologize. And it went down to $14.88. That was almost a 13% drop. Now, like I said, this is for entertainment purposes only, and I was not buying into the stock on preparation for good news, even though I think the stock market expected it. And I also found a lot of evidence to support that. So why was that wrong? Why were we wrong? And this will be very useful, not just in subsequent videos about Tapestry, but just in general. Very important learning opportunity here. So in terms of sales, they were down 19% compared to last year. However, that beats the estimate of the Zacks consensus. So when you kind of look at this, you almost think like they did bad, but they didn't do as bad as expected. So why did the stock drop so much? Well, another interesting thing that we learned is that unlike some of the European counterparts, so for example like Louis Vuitton that we mentioned in last video, their Chinese consumer, meaning the Chinese consumer of Tapestry, mostly shops within China. And that's really interesting because, you know, they're not seen like Louis Vuitton as something where when you go to France, you have to go to Louis Vuitton or whatever it might be to buy a bag there. No, you can buy it in China. It doesn't have the same experience. Maybe there is still a luxury part of that, but since it's more affordable luxury, it's not one of those must-do shopping experiences. And so people are still buying, always were buying in China and still are. They haven't seen serious domestic growth by the fact that there's fewer tourists going around. Now, most of their partners in Europe have reopened in terms of just the supply chain, so that's good. And they mentioned that there was kind of minimal and non-material supply chain interruptions. The raw suppliers in Italy and their finished good products in Spain, they're back up and online. So in terms of supply chain issues, we're looking at something really good here. Now, in terms of brand performance, they were quite disappointed in regard to Stuart Weitzman, especially since there was an impairment charge. We'll get to that in a second. Nevertheless, what's their goal? Well, they have a few goals, but one of the things I thought was most interesting about their goals is the fact that they are trying to be more efficient at segmenting and targeting, and they want to have more customer personalization. So when it comes to these shoe products, they really want to get the right product to the right customer. And, you know, image is quite a big deal when it comes to fashion. So that actually is pretty interesting to me. The other things that they just mention are this idea of buying online and being able to pick up in a store, the omni-channel functionality, and also just making a better browsing experience to allow people to discover and convert into Stuart Weitzman. Now, they mention once again their total sales declined 19%, and this is what I found interesting, that until February, they were seeing total sales actually increase in double digits in Europe, mid-single digits in North America, and low single digits in Japan. And I think that is fascinating. So barring this kind of, issue, medical issue going on, and the countries and the whole world kind of closing down, they're actually seeing good growth. And so I think that's a really positive sign. Now, in terms of, we were talking about before that Stuart Weitzman impairment charge, it's almost $500 million of pretty much goodwill that happened to Stuart Weitzman. And really what that means is they paid a certain amount of money for Stuart Weitzman when they bought it, and it was valued at that purchase price, and so they could turn around and sell it at that purchase price. And that's no longer true anymore. Now they're looking at the value of Stuart Weitzman going down $500 million. So that's not great, and it's not just because of current, but also because of future expected cash flows, right? They're not expecting the business to do so well. Now, they are also talking about the fact that they had $100 million increase due to expense due to inventory reserves increasing. And they also had a $66 million store impairment charge, which once again, we mentioned this last time, that with everything going on, the stores will possibly perform not nearly as well, which we had mentioned. And in fact, the value of those stores that are seen as assets on the balance sheet would be impaired. There'd be a knockdown. We didn't know how much, but now we're seeing $66 million. In terms of how bad Stuart Weitzman did, it's really rough. They went from doing $85 million in the quarter to 50, which is a 40% reduction. That is quite harsh. And probably that was kind of evened out by Kate Spade, which is a larger amount of revenue, only going down 11%. And so that's why we kind of reached back to that Coach middle ground of 20% loss. So not good. Stuart Weitzman, really bad, right? Half their business almost just gone. Now, when we're looking at how much sales were down, we're talking about $250 million, and that's only with 2.5 weeks of stores being closed in North America and Europe. And so for Q4, the next quarter, they're expecting possibly 3 to 4 times worse losses. And so that is actually kind of scary. And we're kind of seeing maybe possibly what drove down the price of the stock so much, this kind of outlook. Now, what they do say is they don't expect to see a significant need to liquidate their products through outlets, although we did mention that on Tmall, they're almost giving I forget exactly what it was, but almost like a 70% reduction in price. So I suppose they're looking at more as a marketing gimmick, perhaps, than the quote-unquote need to liquidate. Right? They obviously don't need to liquidate, but they've chosen to. Now, when it comes to net sales, we can see this is, 1.3 billion to almost 1 billion. That we mentioned was 19% down. The cost of sales have gone up by 50 million, so that's interesting. Now, this is the one that struck me, the selling, general, and administrative expensive, almost, not quite, but almost doubled. That is a serious increase, and I would love to know exactly why that doubled, or almost doubled. And it's not clear to me. Maybe it's because of the supply chain issues. That's very possible, and so maybe those could go away now with everything coming online, or maybe everything going on, and due to the hecticness of the whole system, this is going to continue until things go back to normal. So that's a little bit scary to me. There was an interest expense increase. It wasn't a lot, and same thing with the other expense increase. Doesn't seem to be a lot. So to me, what we're kind of seeing as some of the scary factors going on was that idea that, with only 2.5 weeks in the quarter being affected, they saw such a massive $250 million loss in sales. And so the next quarter, they're expecting, 3 to 4 times greater. So that almost, that's a huge amount. Will it actually be that amount? I don't know. But that almost erases their sales. That's almost what they're saying, right? 3 to 4 times is another $1 billion. I can't imagine it's going to be that bad, but that is what they're saying. And there's selling, general, and administrative expenses have gone up quite an enormous amount. But once again, I assume that's temporary. All these things to me seem somewhat temporary. So it's really hard to see, in terms of the long term, a reason to get out of the company. I really don't see that. Now, in terms of what other people kind of saw as the price decline, well, they mentioned that the earnings per share had a loss of 27 cents versus the estimate of 16 cents. So obviously that was a major factor. What was the reason? Well, they had lower net sales, they had higher cost of sales, and increased interest expense, which we all kind of just mentioned in the previous slide. Now, the important thing here is, or at least the interesting thing here, is they don't mention the increase of the selling, general, and administrative expenses. Now, maybe they include that in the cost of sales, although there was a separate line item for cost of sales. So, once again, kind of useful to look into the details sometimes, exactly where these things are going on, and not just trust other people. Well, I suppose including myself, you shouldn't just trust me. Nevertheless, how wrong were we? Well, on one hand, yes, we were obviously very wrong. The stock price dropped 13%. So totally, I apologize. Although I did say, everyone kind of expected to go up, and we weren't wrong about the sales increasing, actually. The sales beat analyst estimates. So we were actually kind of right about that. Where we kind of went wrong, and this is why I wouldn't have bought on the expectation of good news, although I didn't expect this, is the expenses went up so dramatically that it just kind of wiped away, that positive of improvement on sales. Now, they're mentioning the next quarter that it's going to be down 3 to 4 times. I'm not sure it's going to be that bad. Obviously, they know their business better than I do, but China coming back online, they make up, $1 billion of the $4 billion of Coach, so 25% of Coach. It's hard for me to believe that that's just going to go away. What's the outlook for the company? Well, Stuart Weitzman, they're obviously declining quite a bit. They were declining in North America before, now they're declining also in China. Hopefully they can turn around the company. If they can't, it's obviously a very small segment of revenue for Tapestry, so it's not the end of the world. Even compared to Kate Spade, it doesn't compare. Nevertheless, I think because it's small, it'll be a lot easier to repair the damage and open up new stores, expand, try and focus, try and bring that brand recognition back up. The damage of 40% to Coach would be a lot bigger of a deal than compared to something like Stuart Weitzman. So I think there's a lot of leeway, especially because Stuart Weitzman's so small and a little bit newer. They can play with color. They can do a lot more adventurous things in terms of fashion that they couldn't necessarily do for something like Coach. And maybe they'll be more conservative with it. I don't know. They know this business much better than I do. But I just foresee, because they have so much money, they can really work on improving everything. They have a lot of time to do it. They can last through this whole thing, as far as I can tell. And so that's a really strong positive for the company. Obviously, once again, there's no such thing as a sure thing, but as far as I can tell, in the long term, they're going to come back and they're going to improve. Before everything happened, they were mentioning having double-digit growth in Europe, having high single-digit growth in North America. That, to me, is amazing. So, I think there's a lot of positives to take out of here. And of course, the negative is that this is not going to recover soon, which we mentioned in the original April 1st video. And if prices come back down to that April 1st video kind of level, which I think is very possible. I don't know. This market's really hard to tell. I think, personally, if you've been watching my videos, there'll be another dip, especially with all the economic uncertainty. And so, this is not financial advice, just entertainment advice, but for me personally, I think I would start looking into, once again, buying a little bit more, but until it comes back down to that level, I'm not going to bother. Like I said, at that price, it was a good deal. Still a good deal if you really want to, but I think that there's more, let's say, less risky, still good deal priced stocks, that will grow, and we'll have to keep finding them. But if this one does come back down or shoots down quite a bit, then, it'll still be a good deal and a long-term, very profitable future as far as I can tell. Thanks for watching. Let me know what you think. And once again, let me know if you prefer these kind of shorter update videos or the deeper, analytical videos, and which companies and which stocks I should follow up on next. Thanks.